Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 10th of October. I'm Daniel Lam, your host for the podcast. During this month, a number of providers have warmed up or at least toned down their bearishness on Chinese equities. Now, one of the follow-on arguments is that funds could be rotating out of Indian equities into Chinese ones, especially when Indian equities reach new highs in late September and therefore prone to profit taking. In fact, today is a most interesting time because yesterday, the RBI Monetary Policy Committee, the MPC, changed its policy stance to neutral from withdrawal of accommodation, i.e. less tight than before. Could this boost Indian equities? Yes, that may help, although fiscal policy is still restrictive. Now, the BJP government aims at reducing its fiscal deficit from 4.5% to 3% of GDP. Now, the government's primary expenditure is contracting 7% in nominal terms. Money supply is slowing, there is negative credit impulse, and contracting fiscal spending. All of this will weaken domestic demand. Corporate margins received a boost from steep deceleration in raw materials and other costs over the last couple of years, but this one-off boost is unlikely to reoccur. Thus, there is risk of falling margins, pressurizing stock multiples. Now, Indian stocks are currently overvalued by 2 standard deviation in absolute terms and 1.5 standard deviation relative to EM equities. The September CPI release is going to be on the 14th of October. That is going to be critical. There is upward pressure on CPI inflation due to fading base effects and a likely sharp increase in vegetable and edible oil prices. A return of CPI to about 5% would reinforce the stickiness of inflation. Headline CPI inflation has failed to stay below 5% for more than 3 straight months since late 2019. Persistent food inflation has been a concern, given the eventual spillover to inflation expectations and headline inflation. So all these factors, plus the resurgence of Chinese equities, can lead to short-term pullback in Indian equities. We, however, are remaining overweight Indian equities, and we continue to see favorable demographics as a key differentiating factor between India versus the other major economies. Its growing middle-class consumption is another important long-term driver. Technically, the 20,000 and 22,000 area on the Nifty index seems to be a sensible level to add to Indian equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.